All right, let's jump right into it. Today, we're diving into the latest numbers from EnerSys, a big name in industrial power. And boy, did they deliver a quarter that not only beat expectations, but also sent the stock to brand new highs. So let's get into it.
So yeah, you had a beat, a raise, and a nice rally in the stock. Everything you want to see. But the big question, the one we're all asking, is this momentum for real? Is it sustainable, or is this just a temporary blip? That's what we're here to figure out.
Okay, let's get into the nitty-gritty. On the top line, revenue came in strong. A solid beat. And adjusted earnings per share, an even bigger beat. Now, I know what you're seeing, that miss on GAAP EPS, right? That's the official by-the-book number. But that was all about some one-time accounting stuff. And as you're about to see, the market completely looked past it, focusing on the core business strength.
And here's the proof right here. The market saw the signal through all that noise, and they voted with their wallets. The stock popped on the day of the call and then just kept running to new 52-week highs. It's a fantastic reminder that at the end of the day, a strong core business is what really moves the needle.
Okay, so how did they pull this off? What was actually driving this awesome performance? Let's peel back the onion a little bit.
It really came down to two powerhouse segments. Energy systems up a solid 14%, and specialty up an incredible 16%. And what's so interesting here is that this wasn't just a case of a rising tide lifts all boats. No, this was very specific, very targeted strength, and it's plugged into some massive long-term trends.
And those trends? Well, they're two of the biggest stories in the market right now. First, you've got the absolute explosion in AI data centers. I mean, they need a staggering amount of reliable power, and EnerSys provides it. And then you have the defense sector, which got a big boost from their recent acquisition of Bren-Tronics. So you can see they've positioned themselves perfectly for these huge secular tailwinds.
And you know what's even better than strong sales? When those sales turn into cold, hard cash. I mean, look at that number. Nearly $200 million in free cash flow in a single quarter. That is what we call a cash-generating machine, and it gives them a ton of flexibility and options.
Now, this slide is super important, so pay attention. We got to talk about profitability. That top number, the adjusted gross margin, looks fantastic, right? But it's getting a little help from some government tax credits. Here's the real story, though. Even if you strip those credits out, their underlying margins still went up, and by a good amount. That tells you this is real structural improvement in how they run their business.
And that kind of improvement doesn't just happen by magic. It's all part of a very deliberate plan from management they call EnerGize, and it's clearly paying off.
It's pretty straightforward, really. It boils down to three key things. Optimize their core business, just get better at what they already do, invigorate how they operate, making the whole company faster and more agile, and then use that strong base to really hit the accelerator on growth.
And this isn't just some corporate buzzword bingo. Check out this quote from the CEO. It's a perfect example. They're taking projects that used to drag on for a year and a half and knocking them out in just one quarter. That's a total game changer for their agility and their ability to win new business.
And it's not just about moving faster, it's about being smarter with their money too. They've got this huge $80 million cost-cutting program in motion, and it's set to add a cool $30 to $35 million straight to their net savings this fiscal year. That's a direct pipeline to higher profits.
All right, so that's the story of the quarter. Now let's turn our attention to the future. What's the road ahead look like? What did management say in their guidance?
Okay, the guidance for Q3, in a word, strong. Very strong. Revenue growth looks solid. But again, you have to look under the hood. You pull out those one-time tax credits, and what do you see? Core earnings are expected to grow by around 46%. 46%! That is just phenomenal operating leverage right there. So everything sounds great, right? Which leads to a really important question. If things are so rosy, why did they stop short of giving us hard numbers for the full year? Well, their explanation basically boils down to playing it safe. You know, they mentioned the shaky macro environment, customers changing their order patterns, the usual stuff. But, and this is the key takeaway, they were very clear about one thing. For the full year, earnings growth is going to be faster than revenue growth. So they're basically telegraphing that margins are going to keep getting better, even if they can't pin down the exact sales number just yet.
Okay, let's wrap this all up. We've got killer results, a smart strategy that's clearly working, and a really confident outlook. It's time for the verdict. What's our call on the stock? Plain and simple, our rating is outperform. all the evidence we've just walked through points to a company that is absolutely firing on all cylinders in some of the hottest parts of the market.
So, what's the whole thesis? Let's break it down. You've got a top-tier company riding the massive AI and defense waves. Their internal EnerGize plan is delivering real, structural improvements to their bottom line. They're an absolute cash flow machine. And maybe, most importantly, the stock is already proving it. It can beat the pants off its peers.
Okay, so that's the analysis, but how would you actually put money to work on this? If I was in a room with my portfolio manager right now, here's the trade I'd be pounding the table for.
Here's the idea. A classic pairs trade. You go long EnerSys and you short the broader industrial sector ETF, the XLI. Look, this is not just about betting that the company will do well, it's a conviction call. It's a bet that this superior company, with its powerful growth drivers, is going to keep outperforming the rest of the sleepy, cyclical industrial pack. You're isolating its unique strengths.
And of course, we have to say it, this is for informational purposes only. This is not financial advice.